So the way I see it is the monetary system is like the Fiat Titanic, and the water coming in is rising interest rates, and Japan is leading that. So you have to be very careful, because forget about the US and their 34 trillion. You got to think about the big bubble, the ocean. The ocean out there is the $350 trillion worth of global debt, global credit that is quickly losing value. The one advice I give to people is forget about the price. Worry about allocation. Worry about why you want to own a lifeboat and what should be your allocation. Allocation is key. Too much concern about price instead of worrying about allocation in the sector. Now, what's important about that correction, by the way, the price of gold has always fluctuated 10% at the worst end of the scale in a normal scale since 2009. But 10% of 4,000 is a $400 move, right? So whenever anybody's just talking about price instead of percentage move, run away. Don't listen to that person, because this was not about price. This was about pricing volatility. And what's it going to be at $10,000 gold? $1,000. Well, that's really going to scare people out of it, right?
Jaime Carrasco, good morning to you, my friend. How are you?
I'm well, thank you.
Thanks for coming on. Yeah, happy winter to you, and happy Thanksgiving here in the States. But to all my viewers and listeners, Jaime is senior portfolio, for those who don't know, Jaime is senior portfolio manager for Harbourfront Wealth Management. Really thrilled to have you on and pick your brain here. Let's talk about this run up that we've had in 25. Gold is right around $4,000 an ounce. We did have a pretty sharp sell off here, same with silver, but it really didn't last long. And we really caught another bid here. What are your thoughts? Why the run up, and why is this happening? And does this have further to go?
I think it has a lot further to go, both gold, silver, and the producers. On the producer end, mostly because nobody owns these stocks. We're just sitting. Tavi Costa just updated his allocation chart, and he had brought it up from 1% to 4%, but that was prior to the pullback we've just had. So I would imagine we're back down to 2%, which is nothing. Nothing in the context of history. So if you look at the chart that I'm talking about, and I'm sure I've posted it many times before, it's the last 100 years. How many times in the last 100 years that we have gone through monetary stresses similar to the ones that we're going now, and this one is worse because of the level of credit? What has been the allocation in the sector by Western wealth? Right now, people had it at 4%. I'm saying we're back down to 2% by the sell-off we just had. Well, in prior periods, we had it at 20% or higher. That is ignorance. And that is the fact that we have a generational gap in the Western world, where people haven't grown with an idea as to what gold is, right? To us, we've been pitched that it was the narrative for the last couple of years. It was a barbarous relic. It was a pet rock. Well, it's still money. And because of that, it's going to be an expensive lesson. And the lesson that they're figuring out now is the fact that the companies are making a lot of money. The free cash flow. It's funny, NVIDIA came in just yesterday or this week with 46% free cash flow margin. Well, guess what? That's what Agnico's hitting right now. And that was at last quarter's earnings, which was $3,700 gold. And now we're sitting at 4,000 and getting better. So those earnings are now the cash flow parameters of some of the companies in the precious metal sector starting to really kick in, but the money isn't in yet because of ignorance. So eventually greed kicks in, and that's starting to happen. People are wondering, are looking at it. They probably don't understand why gold is going higher, which is really at the core of history and economics. And we can talk about that in a little bit later, but they're noticing that they're making a lot of money. So greed is leading the way now, and money will come in because the historical precedents that investors have to understand, whether their advisor gets it or not, is the fact that in periods of financial stress, the only sector that produces earnings growth is the precious metal sector, because it's keeping up with the rise of gold and silver. So we have massive disconnects. The real question is, where's gold going? because everything will follow. And there is where gold is returning to the monetary system to do what it has done for 4,000 years. Whether you want to fight that fact, fine. But you know what? The ship is sinking and credit rates are going up. So the way I see it is the monetary system is like the Fiat Titanic, and the water coming in is rising interest rates. And Japan is leading that. So you have to be very careful, because forget about the US and their 34 trillion. You got to think about the big bubble, the ocean. The ocean out there is the $350 trillion worth of global debt, global credit that is quickly losing value. And that's what rising interest rates, long-term rates are signaling. The central banks are like the bilge pump of the Titanic. They're just pumping water out. But the ocean is long-term rates. All that credit, and we're talking trillions, 350 trillion worth, that is devaluing because these countries can't pay it back, right? And that is the opportunity. And the quicker people realize that the opportunity is not in the Titanic, the opportunity is in the lifeboats, which is what I figured out. And that's why I'm very happy just sitting on these positions. The one advice I give to people is forget about the price. Worry about allocation. Worry about why you want to own a lifeboat and what should be your allocation. Allocation is key. Too much concern about price instead of worrying about allocation in the sector.
Yeah, let's talk a little bit, work that out a little bit more for me. I have a few questions on that, and I pretty much agree with everything you say, but still want you to answer these questions in the context of pushing back, if you would. But first of all, maybe look at the price of gold, price of silver as a baseball game, if you would. What inning are we in, would you say? We're no longer in the first inning, I would argue, but we're not in the ninth inning either. So what would your assessment
Gold right now has definitely begun the game. And the game started, the national anthem was over when we broke above 2,000. Silver is just listening to the national anthem. Once we break above 50 here, that's when the game is on, because that's when we start the catch up. The producers, the crowd's just coming in because of the level of ownership within the sector. So that's the way I would say that in terms of where we're heading, right? Gold has to go a lot higher, right? The key matrix that I always use for that example is Sultan Posner's work at Credit Suisse before they went bankrupt.
Great analyst, by the way. Go ahead.
Yeah, and when he posited years ago, when we started this whole discussion about the BRICS using gold for trade settlement, he said, well, if the BRICS alone, and we're talking about the 5 countries then, not everybody that's joining them now, were to start trading gold versus the petrodollar to just settle oil trade, what would the value of the reserves have to be? So what he's asking is, the level of oil trade within the 5 countries is a known quantity. We know how much they trade, and in the past years they were paying in petrodollars, the US dollar. Well, if that trade settlement was to shift to a gold-backed system within these 5 countries, how high will each one of their ounces have to be? His number was $7,000 an ounce. So that gives us one little matrix as to just for those 5 countries, oil, not just gas and everything else, just oil. On the other side of that, we have a couple of data points as well that have come out of the US itself, where Scott Bessent has been saying that gold is important, the rise in gold is good for us. Well, Judy Shelton proposal of using or setting up a $5 trillion gold-backed bond paid back 50 years, backed by the US gold reserves, also gives us a little bit of a data point as to how high gold could go. And what's important about that is that for the 8,900 tons that the US has to be equal 5 trillion, each ounce would have to be at least $20,000. So that both of those data points give us a realistic number of how much gold would have to be to do what it has done for 4,000 years. All that's important for the average investor is that it's a lot higher than 4,000. So there's a lot of money to be made. Then you start to strip it back and you start to think about, okay, if gold's going to $8,000 at Sultan posit, well, silver has to go a lot higher. Silver to me is the biggest opportunity right now, because at $50, that's an 80-to-1 gold to silver ratio. Now, why is that important? Because the gold and silver ratio is not set by the bankers. It's not set by the shenanigans of the market. And let's talk about this in a second, because the Financial Post had a really interesting article just last week on this, how the big surprise that the Chinese were taking more gold than they thought. We'll talk about that in a second. But what's important about the 80-to-1 gold-silver ratio is that is a paper anomaly. The reality is that for 4,000 years, and it's not different this time, the price differential between gold and silver was dependent on the mining ratio. How much gold did we pull out of the ground versus how much silver? Well, last year was 8-to-1 because we haven't been building any silver mines. We haven't been looking for any silver mines because the price hasn't demanded. So since the price hasn't gone up, now we have a massive problem because silver is a byproduct. The bulk of silver production is coming from copper mines, from lead mines, from gold mines, not from silver mines. We don't have any silver mines. We're not building any because the price hadn't run up. Well, here comes a wake-up call. Here comes that expression, you can dismiss the reality of something, but not the consequences of that reality. Well, here we are. We have a massive 5-year deficit now in silver production. The demand for silver just on the manufacturing base continues to go up because it's the best metal for the green energy that the new community wants to set up. Well, the silver isn't there, and silver is needed. So now we're playing catch up just on the industrial demand. But the important thing is that now, because the price of gold has run up so much, we're having that substitution effect over to silver, where silver is being demanded for a monetary metal. So now we have a brand new global demand kicking in. We're seeing it in China. We're seeing it in India. The Indians tend to be the best buyers. They're always seeking the best deal, and definitely silver's it. So that price catch up has begun. Now, to me, I'm not worried about price. Again, I don't think about price. I think about the ratio. So my strategy is I've been buying a lot of silver producers because I think that's the opportunity. The gold producers, that money was made between 2015 to 2020. I build my positions. I have them. I'm sitting on them, but now I'm building silver positions because my strategy is to hold those at least to a 40-to-1 gold-silver ratio. And I'm using a ratio because right now we're at 80-to-1, but gold continues to run up. So I'm not going to start to guess when we get to a 40-to-1 because who knows where gold is going to be by then, right? So I'd rather use the ratio. And then behind that, I have the companies. And so in the companies, I got to tell you that these companies are still trading as though gold is sitting around $2,000. They haven't even caught up to $4,000 gold. And we have those earnings coming in. And that is because nobody owns them. So the opportunities are there. So which brings us to when somebody comes knocking in the door is, well, I don't have any, how do I build a portfolio? That's a completely different question, right? Let's talk for a second, if you don't mind. Do you have any questions, by the way, because I tend to drag on for a bit.
No, let's go there. A few questions, but you're already going to go there. Really, my questions were, and again, we're going there, is I talk to juniors really every single week. I talk with developers every single week. And I talk with many producers every single week, and even the small producers are just printing, especially the small producers, they're printing money at these levels. It's really a great time in the world to be a producer. Yeah. Okay. But really my question is, and I'm a little surprised from this, is that there hasn't been more merger and acquisitions here. I had the expectation in 25 to see that, and it looks like we're starting to see that now. Twofold question: where do you see the producers, if you would, generating? I mean, they're going to have to acquire, correct? And then, just comment about the whole mergers and acquisitions thesis that I have, and I'm assuming that you share.
Well, first, before we go there, let's talk about one important component here, and that is the price, right? So the Financial Post had this big warning that, the Chinese have been buying gold and silver, gold over the last couple of years, 10 times higher than what was reported, right? And it was a big scheme. Well, it wasn't a big scheme. It was the media not doing their job once again. And the reality is that the issue was that one of the things that I keep pointing out is that position limits aren't being regulated. Position limits means that if I'm the futures exchange like the LBMA, and I know that we have 1,000 tons of production this year, I can't go and sell 3,000 tons worth of paper contracts. There's a limit to how much I can sell. Well, that hasn't been regulated by the regulators, both at the LBMA and the COMEX, right? And so today we have a situation where they've sold forward paper contracts that they do not control in years worth of production because the regulators weren't doing their job, because they're going to go work at one of these firms after. Let's call a spade, right? It's the same thing as '08. That big. Now that creates a massive opportunity, and people better wake up and realize how the game is being played and what is the opportunity. Because if they had regulated position limits, the price of gold would have kept up to keep track with the demand that's coming out of Asia, and the price would be much higher than it is today. Well, that's created a massive opportunity, because that's why the producers haven't run up. That's why nothing's run up. But now price is being lost because they can't control the price anymore, because there's this new thing called the Shanghai Gold Exchange that is the new price setter, right? And if you notice, the price is always higher over there, and they're keeping a spread. Now, there's a big difference between the Shanghai Gold Exchange and the Shanghai Futures Exchange, because Asia, China, has actually separated the future contracts from the physical contracts. So physical deliveries happen at the Shanghai Exchange, and they are the new king in the road here. And the COMEX and the LBMA are becoming irrelevant. And that's important because we're losing the pricing mechanism of the commodities, which means that they're going to be the leaders and set the new monetary standard. And that's why it's important, because what we're watching is a transition of power. Mm-hmm. And in that transition of power, the number one rule of power is he who has the gold sets the rules. And so you better get on with it. And that's why it's so important to understand the game that's being set up, or you're going to get left behind. And if you are left behind with everything that's being presented to us, it's your fault, because you're not seeing this thing play out. Now, so let's go down the value scale here. So,
I have a question about that, or a comment.
Go ahead.
Real quick. Yeah, real quick. So about what you just said about the exchanges, whether that's in London or in New York. I know platinum, and I'll say palladium, and I'll throw in nickel there. London had a problem in the last few to several years.
That was nickel.
Exactly there.
Nickel was the big one.
Nickel was the big one. Do you see that playing out again similarly in gold or silver?
Not in gold. I think gold is much tighter control, because it's the central banks are buying them, and they need to keep some kind of price parity there. But definitely in silver. Silver is the one that once it unpegs, watch out. You better be ready. Have your investments in place, or else you're going to miss it. And
I'm laughing. I'm laughing not at you, but just about the idea. And I agree with your thesis. I share the same thesis. I mean, you could easily potentially see a lot of silver fireworks, if you would, in silver. But go ahead.
Well, the inflation adjusted price right now at $50 doesn't make sense at all, because it's the last time it traded at 50 was in the 1980s. What can you buy from the 1980s?
Right.
That's less price today than it was then, especially something like silver. It's ridiculous when you think about it, and it's a massive opportunity to those that can see opportunities, right? Well, one of the problems with the street today, both Bay and Wall Street, is that advisors aren't thinking. They're just parking assets, right? Because they're not stock picking. They're just putting it in pools that they don't really care. They just look at these pools and they look at the past track record. Oh, this is a good investment, without realizing that, the Titanic looks really nice, but it has a hole in it.
Right.
Right? Until after it sinks. So to me, that creates massive opportunity, because he who can think in this environment can make some serious. So, it's funny, because the gold sector today is Warren Buffett in 1998, when he was on the cover of Fortune magazine, because he's lost it. He's not jumping on board with Microsoft. He was sticking to his theme. Well, that was when you should have been buying Warren Buffett, right? Yeah.
I remember that.
Yeah. You know what? Those are massive. I always look for contrarian indicators. A contrarian indicator to me that this was a bottom happened exactly the week prior to Beaver Creek this year, because that week in Canada has been the base for global resources forever. Well, what happens that week? Newmont left Canada, the TSX exchange. Teck gets bought out by a BHP, our biggest copper producer. And then Barrick, which is the worst run company, like if you want to put lipstick on a pig that'll fly at higher prices, that one's it, left Canada, right?
Yeah.
The mine
Are they even producing gold? Or do they want to produce gold?
They're not even a gold mine anymore. The price of gold has always fluctuated 10% at the worst end of the scale in a normal scale since 2009. But 10% of 4,000 is a $400 move, right? So whenever anybody's just talking about price instead of percentage move, run away. Don't listen to that person, because this was not about price. This was about pricing volatility. And what's it going to be at $10,000 gold? $1,000. Well, that's really going to scare people out of it, right? So again, but what happened in that is that we had a massive shake out of the producers again, a great opportunity of reentry. So if you're worried about price, you're not jumping on board. The way that you should be thinking about it is allocation. How much of my portfolio should I have in the monetary metals, be it physical or the producers, where the speculation is, or developers and explorers, which are a completely different animal, as my allocation? Now, coming from Latin America, I'm from Chile. I was director for Scotiabank. I was covering Chile. I have worked throughout Latin America all my life. You know, we've gone through these monetary issues forever. And from LATAM experience, I can tell you one thing: 10% is not enough. The minimum you need to actually protect your investments from the loss of purchasing power of the currency, which Latin Americans fully understand when we look at our peso or the bolivar or whatever the currency happens to be in our country, but this time it's the US dollar is the currency reserve, is 20%, just to protect. If you want to benefit, you got to go to 30%. So that extra 10% you can rejiggle and reprice to take advantage of the opportunities.
A quick comment on that. I believe it was Goldman Sachs.
Yes, Jake, no, it was Morgan Stanley.
It's Morgan Stanley. They came out, I want to say it was a 15%. I was shocked. 20%.
They said 20. They said 20.
But Goldman Sachs did it as well. But go ahead.
But that's important. I'm glad you mentioned that, because at 20%, they have 1.6 trillion in assets. So let's do the numbers here. Them alone is 2,000 tons of gold to get them to 20%. Where the hell are they going to get that gold from? They're going to get it from China? No bloody way. They're not. The gold that's left is not coming back. These countries are never giving it back to us. Well, what about UBS and RBC Dominion, TD, and everybody else? We don't have that gold. People better wake up how dire the situation is for real money, right? And so when you start to think about that, the real assets are those reserves on the ground, so the companies I own. Right? Because there's another matrix where gold is stored in the ground. Nobody's going to steal it. You got to mine it. And to mine it, the cost of mining is so much lower than the current price. So you have a massive arbitrage of opportunity that I'm taking advantage of. That's why I'm not letting my stocks go. But that's a really good point, that the diversification into the sector hasn't even begun. These companies are, and so let's think about China for a second. China is fully taking advantage of the fact that gold now is a tier one asset. So it's the equivalent of the US dollar. So central banks now are the biggest buyer of gold. They've already surpassed their value of treasuries versus gold. Forget about the North American pension plans, because those guys will be the last ones to come on board, even though the pensioners are going to have a little bit of a trouble. But let's not mention that. So that's what everybody has to think on their own. Well, Chinese institutions, pension plans, the banking sector is already increasing their gold allocation because they know what's coming, right? So as we go through that transition, we're talking about $300 trillion worth of credit that is quickly devaluing, that needs to get into safe asset, into safe harbor that's left, because it's not debt anymore. Money is not going to go out of the stock market and go into debt that is devaluing. It's got to end up in this little shot glass of golden shot glass that is so puny right now that it's an amazing opportunity. I've never seen a better setup of re-entry into one sector ever. And that's because of the ignorance that was pitched to us about the barbarous relic and all that. So again, you know, as far as investors are concerned, I would urge that, first of all, think about the fact that what is gold and why do I need it and how much do I need to own? Gold and silver and the precious metals. Again, 30% is the bare minimum if you really want to make it through what's coming. And if you don't see what's coming, then you don't know the value of money, because you should see it in your bill. You should see it in your food bill, in your cost, everything, your taxes, right? Canada, the solution to everything is, let's increase taxes some more, right? And we keep giving money away that we don't even have. So where's that going? Well, maybe it's the reason why gold in Canadian dollars is now $5,700.
Right.
And the better the government we elect, the higher it goes. I'm being sarcastic here. I don't believe I'm completely politically agnostic. I'm just looking at it as wind in the back of my sails. It's just going to push me even further.
Yeah.
Right.
Well, let's talk a little bit about mergers and acquisitions, and talk about portfolio construction here in the we said off camera in the theme of buckets, but you use your sailing analogies for that. So go ahead.
Okay. So let's separate those two for a second. Let's come back to mergers and acquisitions a little bit later, but let's talk about portfolio building. Okay.
Yep.
So first of all, I look at physical no different than cash at the bank. You don't want it at the bank. Physical, you want it at home or store somewhere outside of the system, right? But whatever portion of cash you want to have some in cash, you want to have some in gold bullion and some in silver bullion. If you don't have any gold right now, forget about gold, just stick to buying silver, because silver is a gift. At that 80-to-1 price differential, there's still massive upside, but you better hurry up. And people are waking up, by the way. You see that at Costco. Costco's selling out of physical silver faster than they're selling out of physical gold. So people are waking up, right? The smart institutional money manager, pension manager isn't yet, because those guys are fat enough with their wallets and their income that they don't really have to think about it. They can keep everything steady. They'll be the last ones. But the individual owners of those pensions better start thinking about it, because you're seeing it on your wallet. The problem with the pension plan that they always react late is that at the end of the day, that pensioner is still getting that $1,000 worth of that check. But that check's only buying you $100 worth of things because of the appreciation of the value, right? So that's your physical. And you want that physical for the possibility that if we go through another huge monetary storm, they shut down the banking system and you need to barter. That's what you want it for, right? Then the speculation comes in the companies. First, the producers, between gold and silver producers. Good quality producers, I use 4 quadrants: reserves on the ground, management, cost of production, and geopolitical risk. Where are the mines, right? That's very important to be diversifying. We've been buying a lot of assets in the US. I love the US. The US mining has to fully open up, and it looks like the Trump administration is definitely going to open the doors to accelerate mining at a faster pace. That's also happening in Canada, because we're realizing, wait a minute, we need to start to get the things out of the ground, right? And within the producers, I would say, take a look at building a portfolio that it's at least 50-50 producers, gold, silver, to 60% gold, 40% silver, right? So that is what you want as your main sale. Then you start looking at the next level, which would be the developers, companies that are developing mines that are going to be starting up. You know, you have, for example, look at what's happened with Talisker, with Scotty Resources, all companies that have had that re-rating, where they've gone from being a reserve on the ground already found to a mine that's going to get developed. So they have a nice jump up, right? And then there's the next jump is once they start production, because then so the matrix of value starting to play out. Now, considering the value right now within the gold and silver companies are where they're trading, because they haven't really caught up yet, there's no need to start risking too much money out that spectrum, right? So if I had somebody coming in and say, okay, I get it, I have $1 million, I want to put 30%, 300,000 in there, I would use at least 200,000 of that money to build a solid portfolio of gold and silver producers that we can just forget about within those quadrants. Then the 100,000, I would break up 75,000 to 50,000 in developers. There, you know, you have things like on the development side,
Revival Gold.
Sorry?
I said Revival Gold. There's a name for you.
That's right. Revival Gold. man, you have so many. And the important thing is I don't really want to mention too many because, for example, we just bought into, well, it's still private, so it doesn't really matter. TT Minas, it hasn't gone public yet, where it's a silver miner that is in Peru that's getting restarted. There's a lot of deals that I'm finding where it's restarts of mines that were shut down either in the 1980s or in the 2000s that are now getting restarted, where we have reserves on the ground already found at ridiculous prices that can easily get restarted. And those I love right now because those are coming out of the woodwork and we can find. So no need to go after exploration just yet, right? But that's where I would be in that development spectrum. And I should have probably looked at my list of developers before we started the call, but Revival is a great example. You've got
Liberty Gold, I guess is
Liberty Gold, exactly. You have some of the silver ones. So yeah, the even one is Bear Creek, where the price has been going up and down. Galantas is another one that just did an amazing acquisition, right? Companies that have gold already discovered with mines that were shut down that are going to get restarted. But again, back up a bit and realize that there's a lot of value in the companies that are already mining. Whose costs are that the mines have just started. A great example of a list there. You have Kuya, you have Avino, you have Abra, right? No, Abra is more of a developer. But anyways, those other two, that the PPX, another one where the mine just started, and now it's massive ramp ups, right?
Right.
So once they go through that transition, and then the Explorers. The Explorers has been the spinnaker of the portfolio over the last 4 or 5 years, where you've really seen a lot of value. And there is a little bit harder, but you want to make sure you buy 5 or 6 of them, right? So you have companies like ATAX, which has a massive discovery ongoing in Chile. You have companies like Newfoundland Gold that now we've gone from discovery to getting bigger and bigger, and we're going to have to develop a mine at some point. You have Abra Silver in Argentina, which is a great amalgamation of properties. And now that we're figuring out how much silver there is there, and it's looking big, right? Mogotes between Filo and Atex that has just begun exploring. So there's a lot of plays out there. But again, what I would say is make sure you figure out how much you want in each basket, and then allocating to the baskets. But don't even bother going out the risk spectrum into the developers and the explorers until you have a nice base of producers, which are still very cheap, and build it there. Mergers and acquisition, I'm loving what I'm seeing.
Oh, real quick though, I need to give a full disclosure to some of these companies that were mentioned. For example, Revival Gold and Liberty Gold, and Abra Silver, I am an investor in. So just full disclosure to all my viewers and listeners. Full disclaimer. Go ahead.
And on our side, all the companies I mentioned, we do have a position in. Okay. So disclosure as well. Mergers and
acquisitions. Yeah, go ahead.
There is where I'm seeing some really interesting things, because I'm looking at, I'm analyzing with regards to the matrix that I look at. So for example, America's Gold and Silver, I believe they just bought Crescent, which was their neighbor in the US. Right. So I thought that was a great acquisition, because here I am looking for US assets. Well, America's Gold and Silver is buying those assets as well, right? So they're adding assets in the US. They paid the equivalent of $2.80 for every ounce of silver on the ground. It's a great merger because it also accelerates their Antonin production and accelerates the Galena production. And Galena, in my opinion, is one of the best silver mines in the world, high grade, and they have Antonin, right? So that was an amazing merger. The other one that really surprised me, that I thought they pulled that rabbit out of a hat, was Galantas. They just bought, and I can't remember the name, a Chilean copper gold producer. Right now, Galantas has a high-grade gold mine that's just sitting there since the 1980s, where they couldn't bring dynamite into Ireland because of the IRA and the issues that were going on there. So it's been stalled forever, right? So we've owned it for a while because I love that asset. I think we're buying high-grade gold on the ground at a ridiculous price, but the shares had drifted lower and lower and lower. I just held it. I didn't add, but all of a sudden, they figure out a way of funding the build out of the mine by acquiring a copper gold producer in Chile lower grade than what OMAG is, the mine in Ireland. But with that cash flow, they can come back at this other one. So I think it's an amazing merger. And that's, I think it's amazing when I'm looking that is starting to happen, because there's very smart buyers out there. And if anything, they're strengthening the position of the portfolio. We are buying new companies over the last, they're still private, so we can talk about it. We bought a new play that came out of just over the last 2 quarters, a new copper gold play in Montana that's coming out of Rio Tinto, already work on the ground, but further work to be done. There was, hasn't gone public yet, but something called Algo Grande, which was a copper gold just drilled down to 200 meters, where they found 700,000 ounces of gold. But below that, now that they've done geomag, you can see that there's probably a porphyry down below, so they're going to be drilling lower. Now that's in Mexico, came out of Minorum. It was one of the assets from Minorum, which were assets that were put together by Peter Magal, one of the best miners in the world. That was a really good buy. Then we did this TT Minas in Peru. But what's interesting about how we paid for those, it wasn't new money. We're just taking profits off some of this growth that we've seen over the last year and just moving back into those new plays. So we're continually strengthening our position. Now, that's the beauty of having gotten ourselves to an allocation level that has grown. So now we're coming at it from a position of strength, and definitely moving ahead much faster than those that haven't even bothered coming into the sector yet.
Right. Do you see mergers and acquisitions heating up even more in 26?
Oh, definitely. I think eventually we're going to see the big boys, some of the bigger boys. Like I could see Equinox being taken out. I could see Orla being taken out. There's a lot to be had still. We're just beginning this game. The mergers and acquisitions haven't begun. What's interesting, though, is that the mergers and acquisitions that are happening now are really low reserve on the ground value, right? You know, it's funny. I love the Fruta del Norte mine, which is Lundin Gold now. I've been in that place since it was Aurelian, since the discovery process started sometime around 2007, 2008. Well, at the top of the cycle, it got taken out in 2011 for over, I think it was $500 an ounce for each ounce on the ground.
Gosh.
By Kinross.
Wow.
$1 billion.
Wow.
Well,
that's
you know
expensive.
what I said about putting lipstick on a pig? Well,
yeah,
that's
that
when
is
I got
expensive.
out of Kinross.
Right?
Oddly enough, 2015, 2016, they realized, oh, maybe we made a big mistake. This is the beauty of those big fat firms with big fat management that just don't think they have the money, which is unlike Agnico. I love the Agnico Eagle management because those guys are smart money managers, right? So anyway.
Speaking of which, I don't know. I'm assuming you know Hugh Agro of Revival Gold. I spoke to Hugh. This was about 2 weeks ago. He was at a conference in Idaho, and he just made the comment, Agnico has landed, meaning they're looking for acquisitions. I'm assuming they are at that conference, but they're starting to really poke around here. So it just got my idea of just, hey,
with a cash flow margin greater than Nvidia, yes, they will be shopping.
Yeah.
Yes.
Yeah.
They will be shopping. And that's great, because Agnico has been the main sale of my portfolio forever, right? That's not my biggest position anymore, because some other ones are beating it by far. But it's still a huge position for us. And it's great that they are continually acquiring more and more assets, right? And so that's what I like about a good company like that not only are we acquiring, they are acquiring. America's Gold and Silver is acquiring. First Majestic. The Gatos purchase was unbelievable. Like, people better understand, forget about the tax of the government. Understand to me, Gatos is as important as Kirkland Lake was for Agnico Eagle, right? And so that'll be the growth engine going forward. Yeah. Right. And also a lot of the hurdles of Mexico with the new mine permit
for open and pit. That was starting to permit it now. They're starting to permit it now.
Exactly. Right. So they got their permit, which is great, because that that eases another one of the risks that I was questioning in Mexico. Now I haven't run away from Mexico, but I made sure that so this Rio Algo that we did, it was already permitted. So anybody with a permit, Minorum had its permits in place. That's why we jumped on board there, right? Yep. So I thought, okay, well, anybody with permits is going to be great. Anybody without permits has a trouble. So let's keep building in permitted places. Now we're looking at Bolivia, actually. I love the changes that have occurred in Bolivia. And Bolivia is the Saudi Arabia of silver, right? Yeah. So there's a lot to be had. Like I'm looking at San Cristobal, which is a private play. I was offered warrants years ago, and I passed on it because of the geopolitical risk. But now it's out of the way. But man, that thing's paying out 25% dividend, and apparently the dividend coming this year is going to be bigger than last year. So
that is ridiculous.
It is.
But
good. It's funny because people don't realize yet the cash flow that these companies are generating right now. Yeah, and I think it's amazing because I'm still able to get new clients in and position them properly, right, in a really comfortable lifeboat, because the lifeboats are still empty.
Yeah, exactly. Right. We laugh again, not at you, just about the opportunity and the absurdity of it all, just the value and the money these guys are printing. Jaime, let's land the plane here. What thoughts do you have really for really 26 here? What's your expectation?
Yeah, forget about the price of gold and silver. You better be very aware of what's happening in interest rates. If you look at a chart of gold in every and let's talk fixed income. My background is fixed income derivatives. I was the repo originator here in Canada at Gordon Capital before they unwound Glass-Steagall. So that's why I'm gold focused, because the guys that taught me the bond business was the last generation of bond traders who have worked under a gold standard. And gold was traded ahead of the US dollar and ahead of US treasuries on the bond desk. Mm-hmm. So let's do understand that it was a completely different mechanic. So why is that important? Because if you look at interest rates, forget about what central banks are doing. They have lost control because the bond market is running away. And I'm talking about long end, 10, 20, 30-year bonds right now. If you look at the yield in the 10-year bond in Japan, we just crossed 178, 279 on the 20-year bond, and 331 on the 30-year bond. Well, 5 years ago, those bonds were at less than
zero.
Less than 0.5%.
Right.
The 10-year bond was 0.5 point when gold was at 1,400, and the 10-year US bond now is at 4%. Mm-hmm. So if you don't get the connection of, as JP Morgan said, gold is money, everything is credit. Well, interest rates rising is the water boiling, right? Yep. Everybody else is like frogs in that boiling water. Well, above 4%, the 10-year bond in the US has not cracked 4%, and is not going to crack lower if the 10-year Japanese bond continues rising. Mm-hmm. Why? Don't forget that the bond bubble that we've been building for the last 40 years was on the back of the yen carry trade. Yeah, they are the foundation of the credit cycle. So if that one's blowing up, there's no way that the building above the foundation is going to hold if the basement is crumbling.
Okay, so I got to ask, do you see the yen carry trade has ended or ending?
It has. When you mean ending, is it unwinding?
Yes. I know your answer, but I want you to comment. Go ahead.
Of course it is. Of course it is. It's funny, you know, I wake up at 3 a.m. because when I started back then on the repo desk, I had to get up at 3 a.m. to call our Japanese desk to find out where rates had started in Japan. So by the time I get to my 5 o'clock, I was calling London. See, we didn't have the internet back then, so it was by phone calls to see how the rate cycle was going, because we were shorting Japan, buying in the US because of the differential spread. Well, all that's unwinding now, right? Yeah. And so it's important for people to understand that it's not whatever's happening in your little community. This is a global phenomenon that's unwinding, and it's at 350 trillion worth of credit.
That's huge news to all my viewers and listeners. That's huge news. Just you can even Google yen carry trade or the and
forget Google. Use this Chat GPT, this new thing called AI that they keep talking about.
Right.
Man, it's funny because all of the mergers, I filter through there. How creative is this? Is the question. Or free cash flow for Agnico. I always free cash flow margins come in. Instead of going to an analyst now, I go to ChatGPT.
That is a great idea. That is a great
and I do forward analysis as to, because I like to sleep well at night, so I do it at, okay, what's it going to look like at $5,000 gold, at $6,000 gold, right? And I change the matrices. But anyways, what's important though is do understand that while interest rates on the long end continue to rise, gold isn't coming down, right? So they can try to suppress the price through that unnoticed mechanism that the Financial Post is pointing out of selling forward contracts as much as they want, but the physical is leaving, and sooner or later that game is up. They've lost control. So I personally think that as long as interest rates continue to rise, gold will continue to rise, silver will continue to catch up, and the earnings of the companies is there. So
excellent.
What about next year? You know what? The market could go to 100,000 for all I care. I don't really care, because don't forget that Venezuela, which by the way, has a lot of oil in it.
Right.
Never mind the drugs. Or the Nigerian Christians. I love that one. Oh, we're so concerned about Nigerian Christian. I guess nobody knows that there's a shitload of oil outside of the coast of Nigeria that was discovered.
Yeah, right. Yeah, right.
What I keep wondering is why doesn't Trump just get the CIA to do an orange revolution in Alberta? Because we have more oil and gas, and the pipelines are already built.
Right. Yeah.
Ship it south. But back to interest rates. Don't expect gold and silver to come down. The best performing market in 2019 was Venezuela, because there was nowhere for the money to go. So it was ending up in the stock market. So the market could go to 100,000. But do understand one thing, that monetary crises are always over when the value of gold and the Dow are at the same level. Be it $33 in 33, 800 in the 80s. Is it going to be 100,000, $100,000 gold, 40,000, 40,000? I don't know. All I can tell you is that gold is far away from whatever number the Dow is at right now, and it has a lot of upside, and it's a global phenomenon.
Yep.
Because the world wants gold. No, they don't want the Dow. Right. The Chinese want gold. The Asians want gold. Everybody. Man, think about all those silly Japanese people that were buying gold 5 years ago in Japan. Now they're looking really, really smart, but they're not telling anybody how smart they were. Right. So it's the same thing in Canada. Anybody that was buying gold 5 years ago at $1,500 when we were at $5,700, well, they're looking pretty smart. $70, by the way, on silver.
Yeah.
So it's getting more the premium of the financial lifeboats or insurance is getting more expensive.
Excellent. Well, Jaime, we'll end on that. I want to thank you. I've been a long-time listener and follower, so I just want to thank you for coming on the show. It's great to finally meet you. It really is. If people want to do business with you or reach out to you, how do they do that?
Carrasco at jcwealth.ca is how to reach us, but just follow us on I tend to do more on Twitter, because there I'm constantly talking about the day-to-day markets and what I'm looking at. And on Twitter, on LinkedIn, I also post, but I'm trying to post a little bit more over there. But I find the system's a little bit different. So for the day-to-day chatter, I tend to use Twitter, and that's IJ Carrasco, or find us on LinkedIn. But we're looking for clients, and we have the ability to actually manage money for Americans as well, not just Canadians. And we have global clients. We have a lot of clients in Latin America, and we're not. It's funny. I want to point out that I'm not gold centric. It's just we're sector. We'll take any sector, but right now I'm not worried about the music in the first deck. Right now I'm worried about my position in the lifeboats, because that I think is more important. But we do look at AI. We do look at tech, and any inflationary sector. I love the pipelines and utilities. All those sectors that would have benefited in Latin America as the inflation really kicked in, as the currencies really started devaluing. Those are important to have, and we do manage money in other sectors and develop other portfolios, and we do have the ability to help Americans as well now.
Yeah. Well, thank you so much, Jaime. And for all that, Jaime has been just so gracious for coming on. A big follower, and I really do appreciate that. And also, you're a very busy guy. To all my viewers and listeners, it took us a little while to nail this down just because of your schedule and mine. So you're in the business. So I want to thank you so much on. I'll have you on anytime. Just again, thank you for coming on.
It was a pleasure to have me. Thank you very much, and let's do this again. That'll be
I would,
great.
I would like that. Thank you.
Cheers.